Welcome guys to the trading terminology tutorial of the Trading Basics series. In this tutorial, we'll be discussing some of the common terms that me and some other traders in the group use. But if you're new to the industry, if you're new to this environment, you might not know these terms. And this is just a collection of the most commonly used terms. As I gather more, right? Like if people are confused about something, I will add more to this Google Doc. I will share a link of the Google Doc along with this video so you can refer to it at any point. So let's go through them one by one and I will try and expand on each one of them. The first one is volume. Volume, put simply, is just the number of contracts of something that are traded in a given time frame. So let's say you're looking at the daily chart and you're looking at the stock Apple. So the volume would give you how many Apple shares were traded in that day. That's it. The next one is S&P 500. S&P 500 is a weighted average of the top 500 companies in the US. It's pretty obvious that not each company can be given equal amount of importance. Some companies like Apple would get more importance than a State Street Bank, for example. So you take a weighted average, you denote certain percentage to the share price of each stock, each company, and then you combine it all in order to find S&P 500 index. Why is it used? It's used to understand the health of the American economy and market. It's a simple way because combining data from 500 different companies. Now, given that it's an index, you cannot really trade it because there's no way to trade. It's just a calculation, right? So the way you trade the S&P 500 is through an ETF called SPY. Now, you don't really need to understand the intricacies of ETF or who owns that. You just have to understand that you can buy SPY and participate in S&P 500. Then you have ES, which is S&P 500 futures. That will come later. You don't really have to worry about yourself about futures right now. Then you have NASDAQ 100, which is another index, tracks the top 100 companies that are not finance related. So think of your healthcare stocks, think of your technology stocks. Most of them come in the NASDAQ 100. QQQ is the ETF that allows you to trade NASDAQ 100. You cannot directly trade an index. You have to trade it through a medium, and QQQ is your medium. NQ is similar to ES. It's the futures on NASDAQ. Now comes the more important terms, day trade. A day trade is when you enter and exit a trade on the same day. Why is that important? It's important because in the US, there are some regulations to protect small time traders from themselves, and the government wants to define it that way. Oh well. It's called a pattern day trader rule. It means as a person, you took, I think, 4 or more day trades within a 5 business day period. Once you do that, and if you don't have $25,000 in your account, they will block your account only if it is a margin account. If it's a cash account, pattern day trader rule does not apply. So if you're a small trader and you're starting with a small account, right, and you do want to day trade, that's how you escape the rule. You change your account from a margin account to a cash account. So that's crucial if you're just starting out with a small account and want to day trade. Next term is called unsettled cash. When you make a trade, someone on the back end from the broker has to confirm if your trade happened or not. So when you make a trade and you pay the amount, and then when you close the trade, you should get the money back. Your money, like this trade is confirmed within a 24 to 48 hour period. So you cannot really use that money again until that trade is confirmed. And that's why those funds are called unsettled funds. These are just abbreviations. It's pretty simple. HOD is high of day. LOD is low of day. I don't have it here, but EOD is end of day. DMA, daily moving average. WMA, weekly moving average. What does that mean? It just means a moving average on the daily chart and a moving average on the weekly chart. R2G, I use that quite a bit. It means red to green. What it means is yesterday some stock closed at a certain price. Today it opened at a price lower. So it was initially red or down on the day. Then it went higher and went above the closing price of yesterday. So now it's green on the day. You see, it went from red to green. And then green to red is the exact opposite. Based on yesterday's closing price, the stock opened today or was higher on the day. So it was green. And now at this point is lower on the day compared to yesterday's closing price. So it's red on the day, green to red. OPEX. OPEX is a day when a lot of options positions expire. Why is it important? It's important because on these days you will see a lot of up and down. You don't really see a trending day, a directional day. All right. You don't see some clean price action. You see a lot of up and down. And that's why you want to mark out what these days are. I explained support and resistance in the beginner series. So that should be pretty obvious. And I will use BE quite a bit. It means break even. So now if there are other terms which you're confused about, send me a message in the group, in the noob chat, and I will add them to the video as well as this group. But for now, that's it. Hope you guys learn from it and feel free to refer to it at any point if you forget these terms.